Hello, I have not made a financial modeling video for a while, maybe a couple of months. And in the meantime, I have been working on my book and thinking about whether my book has any relevance to the real world. Now, at the same time, my this could be my sister-in-law who believes there's no such thing as a climate change, at least climate change that has anything to do with what we as humans are doing. Climate change is obviously a extremely complicated, controversial, uh, and detailed subject. I've been watching because of my sister-in-law. I've been watching some of these videos and analyses on climate change from the important physical perspective, the physics perspective, of course, but also economics. And here's what I did not find: I did not find anybody who really talks about finance and climate change, and finance in the sense of finance theory, real finance, not general points. And that's what I'm doing in this video. I'm going to go through some issues and no Excel this time. And this is an extract from my book that I'll put on my website. Originally, I had thought I could make just a couple points about climate change and make my book a little more relevant, which I'll probably never get my book published anyway. Here, what we're going to talk about is investments and real investments. And there are some investments. Now, this video, excuse me for, I should have said this right at the outset. I'm going to try to make this video fairly short, and I'm going to make a longer video that goes through some of the nuances and some of the things in detail, because when I watch some of these climate change videos, they don't kind of get to the point until the end. I want to get to the point very quickly here. There are investments you make to combat climate change. These are adaptation investments. This is my wonderful friends in Malaysia. They had some substations that, because of floods that are at least correlated, we can't say they're caused by climate change, oh no, or man-made or anything else, but they've had to protect these substations. They have had to build these little things down here, these cement kind of things, which might use some CO2 themselves. And these things last a long, long time. And then they can they put the substation on top of that. That's an adaptation in investment. Now, I'm going to go through this very quickly. I'm just going to go through some pictures. When I teach classes, but I don't teach them in a university. I'm not good enough for that. The first question I typically ask in my classes, not always, is which is more capital intensive, this refinery or this solar panel? Which is more capital? What would you say has from an economic standpoint is more capital intensive? Most of the time, everybody says this, and this is, of course, the right answer. The right answer is the relative amount you spend on capital versus everything else. And there's something about, so we have two investments that potentially can combat climate change. One is a solar panel, another is an adaptation. They're both very capital intensive, meaning they last a long time. You put a whole bunch of upfront capital into them, and after that, there's no fuel. There's no burning of fossil fuels. You have fuel intensity, you have operation expense or capital expense. And that's where we start with. We realize that investments that combat climate change are capital intensive. So I've just used an NGCC. In case you don't know what NGCC, that stands for Natural Gas Combined Cycle Electricity Plant. And to get a measure of capital intensity, it doesn't depend on the size. It depends on the amount of capital you've invested divided by revenues. And for a solar plant, you can divide the capital by, I compute a level of revenues, and we get 9 times capital to revenues. For these, it's much, much smaller because we have all the fuel we're burning. Now, here's the theme. I'm going to now try to get to the point as fast as I can. If you've got a capital-intensive investment that, number one, lasts a long time, number two, has a lot of capital compared to all the other operation and maintenance expenses, the biggest one, which is fuel, when you make different assumptions with respect to the returns you're going to earn on this project, or I can call that perhaps the cost of capital, the cost of capital doesn't have much of an effect on a refinery or a natural gas project, but when we get to the capital intensive projects, it has a massive effect. And if I was about to call it science, if the practice and the theory of finance suggests that the cost of capital is too high, is really high, you get a really high, well, it could be in Africa and for country risk premiums, if you get a really high cost, and this makes these projects seem not economic. If you put a low return, then the projects are very economic compared to these. It's essential. Now, people talk about the costs of different alternatives, the cost of nuclear even compared to the cost of a coal plant, for example. The rate of return and the cost of capital is an absolutely essential variable. Now, to study this, you notice I'm just skipping around, hopefully. To study this, I don't start with financial modeling. I start with some philosophical ideas. Now, I can't understand philosophy. I really can't. So to call this philosophic may be not quite appropriate. Mr. Albert Einstein may or may not have said this. Some man named Robert Arnott, in a book called Rethinking the Equity Risk Premium, which is a good book and free on the internet, he said that compound interest is the most powerful force in the universe. You've probably heard something like that. But it is pretty dramatic. Now, in my second video, I'm going to go through all the nuances of this. But essentially, if you have what finance does is it compounds the risk premium you need on an investment. And if you, and this really, things get really, really magnified when you have a long-term investment. I'm sorry about this irritating bouncing around stuff. I don't know what to do about that. A screenshot of it. Okay, I put 3 scenarios with different risk-free rates, and I want to talk about compounding of risk premium if we had put a 2%, 5%, or 8.7%, which I'll come back later why I use that number. Okay, risk premium on these investments. Now I can't see it. Come on. Okay, damn. If we Okay, well, whatever. Oh, shit. Shoot! I'm not swearing one single time in this whole video, by the way. Okay, which is very different from me. If we have a 1-year investment, well, we get 2% return, 5%, 8.7. This is the amount of return over and above the risk-free return. If we go out to 10 years, we get 21%, 62%, 130%. That's this probably not correctly attributed quote to Einstein. And the ultimate question, the ultimate philosophical question is, do you really need this 130% extra return on top of the risk-free rate to compensate for the risk you are taking? Yes. And so I go through and say, look, if you're going to roll a dice, I don't know how to say that, and maybe you could either get a fixed number or you can take a little risk by rolling a die. does that risk compound as you go further and further? Just because you roll the die in 1 year, 10 years, or 20 years, does that risk you're taking in rolling the die change? Of course not. So that's the kind of the first point, and I hope you see how it relates to this investments in climate, combating climate, which are capital intensive and long lived. If we have to give this kind of return to investors, it's going to make them look not very economic. Now, the second point is kind of what kind of risk premium do you just need to take in an average stock, in an average investment in the economy. And here is we can start defining the cost of capital, which I'll do in the next more detailed video. But some man, again, this is our friend Robert Arnott, who said I'm stuttering, excuse me. Corporate profits cannot grow indefinitely much faster or much slower than the GDP. Mr. Herbert Stein, who I don't quite know who he is, so sorry about that, said if an economic trend cannot continue forever, it will not. If corporate goes, if profits grow faster than the GDP, they'll eventually take over the economy. Now, to do this, I make a little graph. I'll explain this in my detailed video, how to get this and all that stuff. But here, I go back to 1980, the first time I made a financial model, if anybody really cares about that. And we do things in real terms. We take out inflation, and we look at the S&P 500 in real terms, which might not be a good way to look at things because the S&P 500 doesn't have dividends. And then we compare that to corporate profits, and then this line right here is the GDP line, and this line is us poor people with our median income. And it's all straight from the Federal Reserve in the U.S., the database. And you can see corporate profits, if you go long enough out, and of course these things depend on when you start, they've grown a little bit faster than the GDP. And because of that, the rest of us have grown slower than the GDP. That's our classic distribution in income. The GDP itself has grown, if we look at the past, 2.62%, but people say, it's going to grow about at 2% in real terms. Everything is in real terms. The stocks, well, they had this gigantic bubble in the year 2000, the dot-com bubble. And then these profits here, these profits are pre-tax. I did them pre-tax because there's some big tax changes that occurred around here. And right around here, there was the big one when the U.S. lowered the tax rate. So this is one reason that the price of the stock compared to the earnings, the P to E ratio has gone up. But to expect this in the future to grow much faster than this, and to expect this to continuing to surge is kind of crazy. So a realistic estimate of the future, the future growth, which is the same thing as our famous internal rate of return, or IRR, is ridiculous. I'm going to talk about this case I work on. I don't get my papers peer reviewed. It's a lot worse. I have to work and fight people on real litigated issues. And this man said that the growth, that the return for general stocks in the economy could be 8.7%. If you do just a little analysis, you see that that's kind of crazy. Then and then the next thing is for people, for young people in particular, to understand that interest rates have declined, not exactly, but pretty well continuously up till the very recent times. to understand that this has occurred, and these has been a more dramatic decline than inflation. Real costs have gone up. That explains the PE ratio being higher. Okay, and so the final kind of point on our second philosophical issue is that this man says there's a embedded. We'll just go to the end. Because most investors anchor their decisions on personal experience, we have a population that largely assumes that this long-term 5% return is their birthright. Well, okay, so he's arguing for much, much lower. Now let's switch again. We're talking about the return on capital and capital intensive decisions, and the third part comes from this book that I used to teach, and I used to think like other people. People call this the Bible. Ooh, the Bible of finance. I think it should be named In Praise of Monopoly Profits and Growth. We're talking about returns as the next philosophical point. This is one of the points they make in the beginning of one of their versions of the book. I can't remember which one. Oh yeah, the 4th edition. Okay. PE and market to book ratios have been significantly higher for the US market when compared to bad Europe and Asia. They didn't say bad. Performance differences can explain much of the difference in valuation, particularly in the case of rate of return on capital. U.S. companies have consistently earned returns on capital higher somewhere than in Europe and Asia. And we see this as proof that the markets really work. Well, if I read that, I almost read, maybe you're not quite reading this the same way as I almost read that rate of returns that are really high are good. And if we look at something from Bloomberg, Bloomberg, it must be right. I don't have Bloomberg, somebody gave me that. And they say here, Germany, they'll take a return of 4 or 5%. This was back in 2021 on a wind farm. US needs 8.8%. Does that mean US is better? I'm not being anti-American or pro-American or anything else. I'm talking about rate of return. Well, what all that means is that you're either charging a lower price for the wind farms, or you're only making a fewer investments. Now I'll come back to this in the more detailed analysis, but essentially here is the big question. If we're going to talk about the Shell oil case, if you need really high returns, well, then you won't make as many renewable investments. That's what happened with Shell, apparently, not exactly at all. But that's wrong from a finance theory perspective. As long as you earn more than your cost of capital and can grow, you don't have to if you earn a really high return on capital, but you can't grow anymore because people have taken enough trips to Disney or whatever they're doing to get your high return, then your value doesn't go up. Your value the economy can prosper with a lower return and a lower cost of capital, as long as you're making this. And here's the value of enhancement for making renewable investments. This idea that you have to earn really high returns violates every single thing about finance, about the basic theory of finance, which says you make positive net present value investments, which net present value is very controversial, and I don't agree with it necessarily. Then the final philosophic issue is, can we just think about what capital intensity really, really is? No money. And the way I try to think about this is think about kind of Robinson Crusoe and leisure time and making a bath for a family. So I invented a simple case. I really had trouble inventing this case. you can either collect fire to make your bath warm. You can either collect firewood every day. That's the fuel intense option. Or you can make a contraption. I can't imagine. I'm trying to imagine some kind of tub you'd make with wood on your island, and the sunlight would hit this wood, and that would heat the bathtub. Now, to make this, it would take me, oh my God, it would take me months to make this. Well, I could never make it, but maybe somebody creative could make this where the sunshine hits the water, and you can heat it up with solar power, or you can make a fire and just collect the wood every day. This is capital intensive, and we have to spend a lot of time up front to make this. This is fuel intensive, and every day we have to walk around and collect wood to do this. That's really the definition of capital intense versus fuel intense investments. Now, when you do that, there's no beta. There's no beta. Okay, we can discuss. There's no. We need to really think about the risk of this contraption falling apart, or risk of us not finding wood when we go and collect the wood. Those are the risks we really need to think about. And there's certainly no country risk premium in any of this. So that's enough for some background. Then the next thing I'm doing here is working through some of the chapter by chapter. So this chapter I just showed you is chapter 3. Now I'm going to show you how basically we can use our climate change as a case study to work through all sorts of issues in finance. The first one I'm going to just talk about is what is really greenwashing. I heard greenwashing a number of years ago. I thought I imagined ExxonMobil, you spray painting green on the walls of their building or something. Well, here's what greenwashing for me is when I really saw it. It has nothing to do. The first thing you do is in your investor report. This is a Wisconsin utility company. You put this very attractive couple, and they have solar power, and they're smiling, and everything is very environmental. Their house looks just with, very climate resilient. Oh, what a good company this must be. And then you realize that every company, and this is the first thing you should, when you study finance, you should understand that there's this graph that says if we can earn a return greater than our cost of capital, then we're in this famous powerhouse square, and that's where everybody wants to be. And every MBA student was, yes, good, get here. Let's do some fancy strategy to get monopoly profits to get here. And these are the bad ones. The worst one is this one, because here we're growing and we're earning a low return. So growth isn't, we got to be careful. So what this company does is they say, okay, let's grow all our investments. Let's show how great investments we're making. Let's grow them like crazy. But then let's go to the government and the regulatory authority and make sure we can get some kind of return above 10 or 11%. These guys are earning 12%. And their stock price skyrockets because they've successfully got into this square without taking much risk. And they've done that through making I'm just kidding a little bit, but they've made these wonderful pictures. That, for me, is greenwashing. You could have just as well given them a return on capital equivalent to their cost of capital and say, go make the correct investments. And then you're not just transferring a bunch of money to shareholders. That's one version out of many of greenwashing, but it's a way to introduce things. Now, the next thing I want to tell you, and when I go through these issues, I hear a lot of these videos where you hear people talk about capitalism and taxes and everything else. Well, I do things from a micro perspective, a firm perspective. That's what we do in finance. And the question is, do you really need to grow? That's the big question. There's these décroissance. How do we need an economy that's going to stop growing? Well, maybe. I'm not going to get into that issue for sure. But what I am going to say that when we do this graph in a much more nuanced way, this, other than our utility company, this area is not a great place to be necessarily, because everybody wants to be here, and you start throwing money here, and you then the returns go down. There starts to be surplus capacity. It is just classic, and the cost of capital can be very high here, even if the beta doesn't kind of reflect that. In this case, we're earning a return above our cost of capital, maybe not much, but we're just keeping calm and carrying on. And there is a very good argument to be made that this is the place to be, not this. These are horrible places to be when you earn a low rate of return, lower than your cost of capital. Here, the problem with this is you're putting a whole bunch of capex and into the firm here, and then you've invested your money, and suddenly everybody else has invested the money, and the price goes down, and you lose money. Okay, and this is all not quite as bad, because once you're here, then you try to get out of your business here. That's basically real business, not this BS. Okay, sorry. So we want to, if the whole world has investments that, okay, let's keep calm and carry on, our life might not be that bad. Okay, that's just kind of an introduction, and then we get into the next issue. And the issue, I totally agree that IRR has taken over the world, and IRR is so much better a way to look at things than net present value, but they're basically really the same thing. Whatever. Okay, we'll get into that. But the IRR has a major headache. It has a major problem, and that's that you reinvest at the IRR itself, and this business of modified MRI just doesn't work. But the problem with the IRR is that it penalizes, in particular, long-term investments, climate change investments. It really hurts them. And I have this other method that I discuss in my book called just the earned risk premium method. How much do you earn over and above the risk-free rate? Compute that instead of computing the IRR. And when you do that, I'm sorry about this graph. You can charge a lower price when you reflect the appropriate. And when you take out the distortions, remember, this whole thing is going through my book and explaining how these concepts in the book relate to this the very important issue of climate change. Now let's move to Shell. Okay. Shell CEO, probably a nice man, whatever, but he seems a little afraid of the investment analysts. Okay, he said the companies, now we're going to focus on shareholder return. Remember that introduction. We're going to focus on shareholder return, and if we invest in renewable investments, they must be consistent with higher earnings. Now, to introduce this case, we can look at this now. If you look over time, I've compared Shell Oil and Total and Exxon. Of course, Exxon, the old Standard Oil, created by Mr. John D. Rockefeller. Okay, and this one's Exxon. This blue line is Exxon, and they had remember when the oil price got to be negative, well, they went way down, and they've gone way up. But if we look at Shell, that's the gray one. The gray one doesn't kind of show up quite as well. Their stock price has not performed like Exxon. Oh no, they must be getting yelled at like crazy by these analysts. Why can't you be more like Exxon? By the way, Total, if you look, depending on when you start, they've kind of achieved the same kind of return as Exxon. But of course, if we started here, we'd get a different measurement and all that. But Shell, poor old Shell, has not performed quite as well. So we'll start looking at this. And when we look at this, then we can see we can get the return on invested capital, and Shell is down here. Oh no, 12%. And look at ExxonMobil, 21%. Actually, Total has had a higher return. Now, I've also included some renewable energy companies. NextEra, the biggest in the US, they have some utility operations too. Iberdrola, EDP, Renouvelable, maybe that's not French really. They have some low returns, a lot lower than these returns on the latest return. Of course, we don't look at this year when the return was really, really low. So we better get out of it. But before we do this, we've got to talk about in this chapter how distorted and how horrible a measure. When we talk about shareholder return, we've got to understand that shareholder return for investments you're making that are young and not old are very low. This says here's the IRR on the bottom, and here's the rate of return you measure from your accounting data compared to the actual return. And it's if you've got a low rate of return, like a renewable investments don't have spectacular rates of return, that's for sure. You only get 36% of 5%. Now, if you get a little bit higher return, it's a little bit better. So the problem here is that when you make some new investments, it's going to look like your returns are very low. We've got to understand some accounting when we look at some of these returns. It's such a basic thing, and it's more aggravated when we include inflation. So if you've only got a 5% return, you're only earning 1.83% on your return on investment in the very first year is only this. If you've got a high return, it's not as bad. So that's a big problem when we say, oh, Shell, we better earn this high return. We've got this accounting distortion. Doesn't sound like a really interesting issue, but it just renders all of our financial statement analysis a little bit nothing. And here's what we can see with this. We can see that ExxonMobil stopped investing, basically. Their capital expenditures relative to depreciation are a lot lower than 100%. They've got to be a lot higher than 100% just to replace their assets, so they're getting old. Shell up here is a little better, but these renewable energy companies are investing heavily. So their returns are going to be lower. These kind of things that might not be very exciting for everybody, but they're important. Now, in the next chapter, I'm just going through chapter by chapter for the book and demonstrating why these points are very real. The people said, well, oil and gas typically range between 10 and 20%. What? Ooh, I cannot swear. But I can say BS, I think. 20% return you can get on an oil investment, that means you are just stealing money from somebody. You're charging too high a price. It's so much above the cost of capital. It cannot be a competitive industry, whereas wind projects are 5 to 8%. Now, we really don't know what they're talking about, if this is the equity IRR or anything else. We can see. But you can see what ExxonMobil wanted to do. This is an old report that I used to use, and I kind of was saying, oh, this shows you all about finance, because here they were earning 31% return on invested capital outside of the U.S. And if you look at their investments, they had more investments, 34 billion or whatever it is. Outside the U.S., this inside the U.S., downstream for the refineries, here was the investment and chemical. And you can see they want to put all their money into the investments that earn the high return. That's the classic. That's our famous, I call this that McKinsey book. That book I just kind of criticized a little bit or a lot. Now, the next thing I work through is talking about these price to earnings, price to book, EV, enterprise value to EBITDA multiples, and does that have any relevance at all to our discussion of climate change and incentives and valuation of different kind of projects? And I say it does, because when we criticized Shell, and maybe this is legitimate, Shell's enterprise value, the equity and the debt, divided by their cash flow, their EBITDA before any capex, was only 3 times. ExxonMobil's was 5 times. So they said, oh, ExxonMobil's much better. Well, that doesn't really mean much. This depends on how much you think that the EBITDA is going to grow, how much capex you have to make to get that EBITDA. And what's kind of interesting is that these companies with the much lower earnings in the renewables had a higher EV to EBITDA ratio. So let's be careful with these things. And if we look at the price to book ratio, this price to book ratio for me is the big ratio. Now, I'll get a lot more detailed into it if you watch the other video, but this says there, those earnings we showed are way above the cost of capital, where Shell Oil is down here. That means if you take the amount of money people have invested and compare it to the market value, it's not a very good story. ExxonMobil's a little better, but the renewable energy are much better. So what's the story here? Shell's exiting the renewable energy, but it's not a statement that renewable energy investments are bad. Certainly, if you look at these other companies, that's what we can do. Now, the next issue I get into, which again, we can say, oh, it's not directly related to this renewable energy. The next issue is the terminal value. Now, the terminal value, any corporation, when you buy a stock, you're buying a stock forever, basically. So I put a picture of Mr. John D. Rockefeller here, and when he started Standard Oil means he kept the oil at the same standard, whatever. Okay, the gasoline or essence or petrol. He kept it at the same standard, and he bought everybody else up. He created enormous monopoly profits. And if you were investing when John D. Rockefeller owned the company, I don't know if it was public or when it went public, whatever, but pretend you were investing back then, you would have to say, could he sustain those monopoly profits, or eventually do they go away? And that's the big question, really, if you're looking at some of it's a philosophic question. I try to go crazy and come up with formulas that get the value of in the long term, but the value in the long term goes all the way back to our beginning. Is there eventually all the assets will go away, all the oil will be drained out, for the current oil will be drained out. The question is, can you get new investments that make a monopoly profit? That's the story. And when we looked at those multiples for Shell and Exxon, it looks like we're a little worried about the long term. Okay. Now let's get back to something that I think is much more relevant to the climate change, and that is whether we should use IRR or NPV in the first place for all of our investments. And for me, the answer is no. I go crazy when I look at development projects. And development are these crazy people who go around trying to find new projects and are totally optimistic, and most of them don't work. They try to find new projects, and we can compare them to development of whatever, some kind of software. My development, which has failed, of my solving circular references in a unique way in a financial model. I thought that would be a good project. It's not worked. Okay. we cannot evaluate these investments with discount rates and with NPVs. How can you not? And virtually every kind of investment you would make would have some sort of development period, some sort of really high risk period. Now, Shell scrapped their hydrogen projects. Hydrogen is probably not economic, at least green hydrogen right now. We have to wait and we have to figure things out. We have to get things right. Maybe, hopefully, we pray it will be working. Now, here's how I relate this to climate change. This man named Simon Clark, one of these videos, he calls this the lost decade of the 1980s. And he talks about this man, John Sununu, whose son, I think, is right now the governor or something of New Hampshire or something like that in the U.S. He put a stop to all of any climate change discussion for the U.S. government. And his big deal was, when we discount those cash flows, the amount of expenditures you would have to make to mitigate climate change, once you account for the benefits and you discount the benefits at a relatively high discount rate, it doesn't work. But here's the problem. If you do an analysis in real terms, which you should always do, not in nominal terms, the real rate of interest without any kind of ridiculous risk premium on top of it, this is the Treasury securities, and the real rate has been maybe 1%. That's the kind of discount rate we should have used. And the right way to make an analysis of a development expenditure is do some sort of decision tree with probabilities and derive. And can you imagine if you did this and you put a weight on the cost and you put the different probabilities in and used a lower discount rate, I could imagine you'd get a very different answer. And that's the way we have to start looking at all sorts of different investments, including those ones that Shell got out of. We can't look at rate of return again. Okay. Now, this is something I get a little more emotional about even, and that's when we measure when we evaluate a lot of these renewable energy investments, not renewable energy just alone, they can be nuclear power, they can be anything. I'm totally agnostic about this stuff, but they're really financed with project finance. And the understanding of the essence of project finance is just so bad. Here's the Investopedia. Project finance is a loan structure that relies on the cash flow for repayment with the project assets as secondary collateral. Nothing. That's not the essence. The essence is if we don't get bank finance, the projects aren't made. The risks of the project, of the long-term risks, can be managed and understood even if there's some commodity price risk. Risks are assessed using debt service, not beta. And the debt structure really drives everything. Now, one of my heroes in finance, I have to say, is Merton Miller, because I met him, and he's just fantastic. But the way we really look at no, I went way too far. The way we look at risks in project finance is we put a lot of debt, and here's a little bit of a debt service coverage, and we sculpt the debt. We don't have to get into all those issues. I've got so many thousands of videos on all that stuff. But then we look at return on equity at the end of the day, and look at these renewable energy investments. They kind of have a return on equity, certainly not spectacular. I printed it out wrong a little there. I'll fix that. And then for of course, whereas ExxonMobil, they got a 28% return, but then had a negative. So these have much more stable returns. That's typical kind of in project finance. And here's what I'm going to do with the project finance discussion. I'm going to show you what the effect of all of this stuff is on a nuclear plant. And I'm going to use this famous report that's made by Lazard, which is an investment banking firm. Okay, and Lazard makes these beautiful kind of football field diagrams, and you can see that, for example, if we look at nuclear, these are high, and they're much higher than coal, and they're much higher than natural gas. So if you read this, nuclear would be bad because it's more expensive, coal would be better, and gas would be better than that. And we're not talking about all this discussion about batteries and storage, and we know all of that. Okay, we'll get into that. That's a different issue. But then you look at the assumptions they make. And they make an assumption, 2.25% inflation, but look at this, 60% debt. Project finance can be 80% debt easily. The cost of debt, oh my gosh, 8% cost of debt. Now, this study was a 2020 study when the risk-free rate was practically 0, 1 or 2%. Oh. And then the cost of equity is 12%. Oh. And not only that, what they do is when they compute these costs, they don't account for inflation correctly. So when you go through this and fix all this, now it's taken a while, but no, it's not taking a while. We can do it with a few very simple formulas and find that we can match basically. I get 0.127. That you can read that as 12.7 cents, or this is like the 0.129. I'm sorry about the 12.7 instead of 12.9. But you can boil that down to the life of the project, the return that you need on the project, the rate of inflation, and the operation and maintenance expense. These are the physical characteristics of any project, and then you convert them and get the total cost based on the inflation adjustments. Now, if you use their method, you get this. But if you use a much, much more reasonable method, and this overall IRR is not the equity IRR, this is the IRR with a debt and equity mix. And in project finance, it's almost all debt, not all, but 80% debt. And if you use a much more realistic kind of approach, and then you account for the fact that the lifetime, everything else is the same except the lifetime of the investment and the returns and the treatment of inflation, we get 5.8, not 12.7. Now, if you go back and if you corrected this, now we'd have to correct this for the other ones too, but then suddenly this 5.8, well, this gas depends on the cost of gas, and then we should add some emissions from that, and add the fact that methane gets leaked out and can make it almost as bad as coal plants, and well, that's a different subject. You get a completely different answer, and this just shows you just how distorted and just how important some of these issues in finance really are. And if you're yelling at me about being pro-nuclear or something, I'm sorry about that, whatever. I'm agnostic, as I said, and here's just kind of what the interest rate really is. Kind of, this is the interest rate at that time. The interest rate on a 10-year treasury was 1.76. Okay, it was a little bit higher. And the credit spread was 1.32. You add these two together, that doesn't give you anything like that 8% return interest rate that they had. Okay, this was going to be a short little summary, and it's not, but I'm going to keep going. Okay, and now we get into measuring the cost of capital. Okay, because this project finance was great. We can measure 80% of the structure of the cost of capital and get these completely different answers, but we still need to measure that last cost of equity, the return on equity. Now, this is where finance just gets completely crazy. Okay, now I guess the way what I'm going to just say is I get to listen to a lot of people. I work on real projects instead of teaching at a university all the time because they don't let me teach there, I guess. Well, I haven't really tried, but I hear all the time, oh, we want double digit. We want a double digit return. Whatever in the heck that means. For me, that means 10.00001. Why they came up with that, is God knows, and that's a very, very high return. Now, can we test? Can we test whether that return is above the cost of capital? Don't use beta. We're not going to use beta. We're not going to use equity market risk premium. We're going to use the fact that you can prove that the market to book ratio, the price to book ratio, is the return minus the growth divided by the return. Now, if the return and the cost are the same, say this is 10 and this is 10, then growth falls out of the equation and this is always 1. It's always 1. If this is bigger than this, then the market to book ratio is higher than 1. And to understand just a little bit of this mathematics before you go through all of the horrible Damadora and crap is so important, okay? And then here's what we can do. We can look at this company. Again, it's kind of like our first company. They've consistently earned just about 10%. They're a company, a regulated utility company, a very stable, boring company. They want to make themselves boring. Boring is good. Boring with growth is even better. And boring with growth and earning a return on capital that's high is the best. That's what you want the whole economy to be, perhaps. Well, except for earning too high a return. And their price to book ratio is way, way, way above 1. So any sense that this return could be 10% is totally disproven. At least we can do something. We can disprove the cost of capital, which is a big deal. It's a really big deal. Here's another company, again, one of my favorites. This is a company in Malaysia, Tenaga. They have a price to book ratio that was kind of hovering around 1. I don't know, the returns weren't quite as stable, but you can see these returns with a market to book ratio of about 1. This means this is kind of somewhere around the cost of capital. Now, if you look at Malaysia, they apparently have a country risk premium of 1.89%. Oh gosh, this makes me cringe. It really, really makes me cringe, and it's the next subject we'll get into. But this is the way to start with cost of capital. No betas, no equity market risk premium. Just go through this. Now, you could even get fancier and doing a little regression. I'm not going to talk about that this much. That shows you the cost of capital is much lower than what people typically use. I've got to take a deep breath now because I'm going to talk about country risk premiums and corruption. And this man, who's probably a very nice man, look at him smiling. He's a teacher. He represents, for me, vested interest in traditional finance. And he publishes a website. And in his website, he publishes 2 things which kill the climate, which kill projects in developing countries, which distort capital intensive versus non-capital intensive in an incredible way. So he can smile all he wants, but that's not very good. Here's what this country risk premium that you're supposed to add to the cost of capital. This is Pakistan. Now, I didn't put the latest in here because I did a real study that ended in 2001. That's gone up somewhere around here because the country has few foreign exchange reserves now. But these numbers that he computes, and he doesn't do anything fancy, I assure you. It's really, really simple what he does. Basically, the only thing he does is he takes these yields you make on the bonds, on the sovereign bonds in USD, and he compares that to USD, and he gets this additional amount, and then he does a little bit of mumbo jumbo on top of that, but that's the rest is minimal. Okay, that's what he's doing these days. He's changed his method over the years. But then, what you can do, this gets back to our philosophical issue on what really is the risk premium you need. And when we're talking about debt, It's very easy. We got a very, very simple formula that says the amount you need to earn, your credit spread, your risk premium you need to earn, is the probability that you might have a default. So if there's 10% chance of default, you take that times, if you do have a default, how much you lose. So let's say we lose 50% and we recover 50%. That would mean that the credit spread would be 50%. Okay. And then, but you can just, of course, reverse this thing and back into this. Now, if we take Mr. Damadoran's numbers, even the numbers which were pretty low, if we have a regular old credit spread on a regular triple B bond, and we say that the loss given the default is about 50%, you can see, well, that implies if you've got a 2-year case versus a 7-year case, it compounds, just like we talked about the compounding of the returns. And this implies that there's about a 16% probability of default in 7 years, and that corresponds to this credit spread. Now, in Pakistan, the best case he had, which is, of course, now completely reversed, the best case he had would imply a probability of default of 63%, even though the country has never, ever defaulted on its debt. And you can go through other cases like that, okay? For Malaysia, you know, we had 2% or something like that. And we could even, yes, that was 2% above the risk-free rate, so we could back into that, and you could do this for different countries. Now, he had a much higher rate earlier, 12% rate, and in that case, after we get to year 5, you get more than 100% probability of default. You can't really have that. But that credit spread would protect you in year 4. If you had a default in year 4, there would be 80. If you made it through 1, 2, 3, there would be an 80%. It's an extremely simple calculation. You're just compounding this rate and backing into the number. And that's completely inconsistent with what the companies actually get through local financing. And it's all the same. And I know Mr. Damadoran says, no, we can't look at local banks. We can't look at local rates, which are dramatically lower. And here's an example in Pakistan where we've got the interest rates. Just a minute. The interest rates to be, but now this is in rupiah, so we'd have to take away the inflation, and you get about 2% credit spread, something like a triple B credit spread. Mr. Damadoran would say, no, we can't look at local stuff. We got to look at U.S. markets in New York from S&P and all that stuff. And instead of saying, well, do these banks that have loaned this money all go bankrupt? That's what you would say. They should all be bankrupt. There's something going on, and there's some big distortion with these country risk premiums. And then if you look at the price to book ratio, you can see if you can find this gigantic cost of capital problem in this again, 14%. This is not in US dollars, this is in rupiah. Take away the inflation and you don't get anything like those country risk premiums. So I hope you see why you get at minimum, you better think about this a lot more than just plopping that number out. In the best case, you really need to look very carefully and think about why you have these things where you find different real credit spreads than the kind of foreign currency. You have to think about supply and demand and whether these people in New York are just adding a ton of extra profit on their returns, and you have to address these things. Now, let's get into a couple of the final issues, the equity market risk premium. So now we're getting into our famous CAPM, capital asset pricing model. Won the Nobel Prize for that. Sharpe did in the 1960s. It says cost of equity risk-free rate plus beta times equity market risk premium. And this time we're talking about these two things, the risk-free rate and equity market risk premium. They are economy-wide. Beta is company-specific. And I've already addressed this a little bit at first, but if this cost of equity is in nominal terms, we could take this risk-free rate divided into risk-free rate plus inflation and then put these two things in here. The only thing that has inflation is the risk-free rate. These don't. So they're always real numbers. That's the first thing to kind of understand about these things. And then you can go back to what's the definition of the cost of capital and think about the definition and say, okay, well, the cost of capital is the minimum return, the minimum, not the actual expected, the minimum return we need to compensate for the level of risk. Or you can go the other way around and say, well, what's a possible rate of return that we can get? And then kind of go backwards and see, well, what kind of risk we can really face. So I'll go through all that discussion here. Now, this is the people I fight with, kind of. They took the growth rates published by Zacks or whoever they are, or Yahoo Finance publishes a growth rate, and Value Line publishes a growth rate, and they take all these growth rates for the S&P 500, a whole bunch of them, and they get that the growth is 12.62%. That's how much earnings are going to grow by. And if you take the kind of a risk-free rate out of that, whatever, you get somewhere, where did I put that, a return of a premium of about 8.7%. There's our 8.7%. Now, Mr. Damodaran, he's Damodaran. He's a little more careful. He kind of had these equity risk premiums being up here, and he kind of goes down, but it went way up here. He suddenly found that the equity market risk premium went way up. Okay, and that's a lot. This is a lot, and this will kill a renewable investment to combat climate change. Now, Mr. Damodaran, he has a very, very different opinion than a bunch of these other studies. Now, I can't find any. I wish I could update some of these studies. We'll look at this more carefully in the next one, but they have 0, 0, 0, 0, 0, 0. His number would be right down here. His number would be higher than all of these other studies. All of these other studies, and it makes a big difference. And to see what a big difference it is, I'm going to now put beta together. And this beta, is supposed to be the only measure of risk that matters. No other, not the DSCR, not the value at risk, not some, evaluation of whether there's mean reversion in cash flows. No, the only measure of risk that matters is the beta. Okay. And then Mr. Eugene Fama, another Nobel Prize winner, said the beta is dead. It's bullshit. We've got a bias in the betas. Low beta stocks have earned high returns and all of that. And then this Mr. Marshall Bloom, who I think who was together with Fama one way or another, he might have been a student. He wrote a paper in the 1970s saying we shouldn't use the beta we compute from statistics. We should weight that by 0.67 and put a 1. And so this is a reversion to 1. The beta supposedly reverts to 1. And if you think these little adjustments to beta and these things don't matter, here's what I'm trying to show you is these things matter a great deal. And that's why we got to go back and really think about, oh my gosh, what is this finance doing? And when we have this inherent bias like Damodaran has to put the cost of capital high, it's great for investors because they can try to force you to, get monopoly profits, which is, of course, what they want. Great, good for them. Okay. Using the high cost of capital is such a sad thing for measuring the costs and benefits of our renewable or climate combating investments. How about if I say it like that? And here's a little example. I use Damodaran versus Damodaran versus 3%. I use a risk-free rate of 3.5%. And this for this beta, I use either the beta from that we plop out from the internet of this one from Market Watch, which has a mean reversion factor, and I use Next Era, or this 0.54 that's just Yahoo Finance computes it just based on a 5-year average. So we get completely different betas, different risk premiums, and we get an enormous difference in the cost of capital. And that matters so much. Oh, I'm going to move here maybe. Okay, and I'm just about finished, finally. Okay. And I get a little emotional about this Bloom adjustment that everybody uses when they plop out the number from Bloomberg, because, and he made this adjustment by doing something very simple because the data wasn't really available. He kind of put some stocks together with low betas, stocks together with high betas starting in 1926. And by 1947, the beta increased. And then he even went to 1954 to 1968. Oh my gosh, it's very current here. And then he did the same thing, and here the beta decreased when it was above 1. So that proves that we got to just take that adjustment, right? Well, when you do it more carefully for individual stocks in an industry, I do this for utility stocks, it doesn't happen. All of these stocks, you can so easily do this yourself, compute the betas yourself instead of plopping it out, and you don't find this mean reversion at all. And then you can go through and when you compute the betas themselves, you can also look at weekly data or monthly data. You can look at different time periods, and then you get these betas. Here, this is the beta after COVID. This is the beta during COVID. You get a gigantic difference for this company in New York City. If you do it with monthly data, you get a tiny beta. If you do it for a really long-term period with weekly data, no reason you can't, you get a different beta. It shows you that you get different results. And then the very final thing I want to go through is this unleveraging and releveraging the beta, which is another crime. And if I haven't shown you in this little session, especially for people who are looking at finance, that basically everything in finance is wrong. I think it happens, but it's not only wrong, it hurts the kind of investments that we need to make to deal with this climate change. So when I just took and relevered and unlevered the beta, and what the real problem here is if you've got an investment that's financed using project finance, where you might get something like an 80% and relever the beta with 80% from a listed company that might have a debt to capital ratio of 50%, and then if you use the mean reverted beta, I get 0.77 times this. This is the asset beta up here. It's not so complicated. There you could make some tax adjustments by Bob Hamada. He's a very nice guy. I spent a lot of time in his office. The debt you get you multiply it by the equity to capital ratio, capital to equity ratio, and you get a number, a beta of 2.85 after you relever it, and that produces a really high return and shows you this all this thing is junk. So that's my introduction, and I just hope, whether you're in finance, I hope some people who are not in finance one day will watch this video. And I hope they can see that this stuff really does make a difference. Whether you are going to debate about nuclear power, or whether you're going to talk about hydrogen not being good or anything else, these things really make a difference. And let me just say one more thing, quit just right now. I want to talk about Ram trucks. People complain about SUVs, sales exploding. Yes, they're bad, but really, when I drive in northern Wisconsin, where is my I see these ones, and it's like somebody giving the finger to climate change. Oh, I can't find my Ram truck. Okay, I'll stop there. I would love to talk to you about how I'm taking my granddaughter around and showing that she should put a sign on each of these trucks. They use about 7 times as much CO2 as a little car. Can you imagine all the steel they use? These are the worst trucks. And then if you go to northern Wisconsin in the US, that's all you see. All these kind of trucks. Ah, enough of that. Okay, I'll stop.